Hello, good evening everyone, and welcome to this week's session where we'll be discussing the basics of trading the financial markets. We're just starting to build up to the 2 weeks live trading session that will be starting in the first week in January. So we're going to start off this week by discussing the basics of trading the markets, and we'll build up to the 2 weeks live trading session. Now, before we start discussing about the basics of trading, one thing you always have to remember that there's a huge difference between trading and investing. Trading is so different from investing, and you need to differentiate them. When you're talking about trading, trading is short-term and investing is long-term. So trading, you're looking at getting in and out of the market within a couple of seconds, couple of minutes, couple of hours, couple of days, couple of weeks, couple of months. And then with long-term investing, you're looking at 10 to 20 years horizon. So trading is short-term and investing is long-term. There's a famous quote from Warren Buffett where he says, risk comes from not knowing what you are doing. And, a lot of people have heard a lot of horror stories about trading, and that's because most people get into trading without knowing what they're doing, and that's why you get a lot of horror stories about trading, and a lot of people lose a lot of money trading the financial markets, and it's just because basically they don't know what they're doing. And hopefully after this session on the basics of trading, you will know what to do as a trader and how you can become a successful trader. The other thing you need to know from the basics of trading is the different types of financial markets we have. The financial markets comprises of 4 distinct parts. You have the fixed income securities market, which is one major part of the financial markets, the fixed income securities market, which comprises of the bonds and treasury bills. Then another separate part of the financial market is the stock market, or as some people call it, equities market, which is the trading of companies, stocks and shares. So the stock market deals in equities or stocks, and that's a separate market on its own, a separate part of the financial markets. Then you obviously have the currency or the forex market, which is the largest of all the financial markets, the currency and the forex market. And finally, we have the commodities market, commodities like oil, gold, coffee, wheat, etc., etc. That's the commodities market. So when you mention the financial markets, you're really describing all these 4 components. So the financial markets comprises of these 4 major components: the fixed income securities market, the stock market, currency market, and the commodities market, and they're all separate from each other. They're all distinct markets, and they all then comprise what you call the financial markets. The importance of distinguishing these separate markets helps you when it then comes to analyzing the risk of the different markets. So with investment risk, if you're looking at low risk, so if you're looking for a market to trade or invest that has low risk, the best is the fixed income securities market, because that's low risk. So when you trade in bonds and treasury bills, that's a low risk market. Then the medium risk is long-term investment in the stock market. So if you're looking in the long term and you're looking to invest in the long term, the best market to invest in for the long term is the stock market, and that's medium risk. And then high risk, which is what we're discussing today. High risk is when you're now trading. And trading, the best markets to trade are the forex or the commodities markets. But that's high risk. So it's high risk with high returns. But high risk means there's a high risk of you losing your money. So again, separating and distinguishing the separate financial markets helps you also analyze risk. If you have a low risk appetite, then you're looking at focusing on the fixed income securities market. If you have some appetite for risk or medium appetite for risk, then you look at long-term investment in the stock market. And if you've got a high risk appetite, then you're now looking at trading, which is what we're talking about today. And the best markets to trade is the Forex or the commodities market. Now, the basics of trading, we all know that trading offers you an opportunity to create another stream of income with good cash flow once you have developed your mindset sufficiently and learned the rules of trading. So there are rules to trading. You need to learn the rules of trading. You need to get your mindset right for trading in order for you to succeed as a trader. But trading is certainly a very good opportunity to create another stream of income. It's not the only stream of income you can get, but it's a good one to add to your multiple streams of income. Also, trading may involve heavy losses, which can be minimized with the development of a good trading plan, which we'll be discussing about in the coming weeks, how to devise a trading plan. So you need to have a good trading plan to minimize your losses. So in order for you to become a successful trader in the financial markets, you must possess what we call the 3 M's. If you apply the 3 M's to every single trade you place, your success as a trader is guaranteed. If you miss 1 M out, your failure as a trader is guaranteed. So for you to be a successful trader, you must apply the 3 M's to every single trade you place. So what are the 3 M's? The 3 M's are the mind, money management, and method. So mind, or the proper terminology for mind, is trading psychology. A disciplined mind is an absolute requirement for successful trading. 90% of your success as a trader is just down to your mental state and your mind. So trading psychology is hugely important to your success, because 90% of your success is down to your trading psychology and your mindset. So you need to be able to control your emotions as a trader. You need to be disciplined. You need to be organized. You need to have a plan. You need to be able to stick to your plan. You should be able to control emotions like greed and fear, because greed and fear are the 2 biggest emotions that can have a negative impact on your trading. So your mindset is a very crucial part of trading. The other M is money management. This is just almost as important as the mind, because with poor money management, you'll soon wipe your account out and lose all your money. So money management is crucial. And the first goal of money management is survival. You want to survive to trade the next day. So you need to avoid risk that can put you out of business. Now, the second goal is to earn a steady return, and the third is to improve on the second. So money management is crucial to your success as a trader. It is a very, very important topic you need to get right as a trader. And this is one of the topics we'll be discussing in detail in the coming weeks, leading up to the 2 weeks live trading session. We need to spend a whole hour discussing money management, because it's a crucial part of trading. And then the final M is the method. So there must be a plan or a methodology to your trading, and it should not be based on tips, hunches, visions, or dreams. You have to have a plan or a method or strategy of how you approach the market, how you enter the market, how you exit the market, and how you apply your money management. So these are the 3 crucial M's you need to apply to all your trades for you to be a successful trader. You have to have a very good mindset. You need to be able to control your emotion of fear and greed. You need to be disciplined. You need to be organized. You need to be able to stick to your plan, and that's to do with the mind. The money management, you need to know how to assess your risk. You need to know how to limit your losses and manage your capital well and not take undue risk. So money management is very crucial. And method, you have to have a plan or a trading plan you've devised of how you're going to approach the market. So these 3 M's are very, very crucial to your success as a trader. And like I said, in the coming weeks, we'll be going through these 3 M's in much detail. So here are some questions for you, food for thought. Why do we trade? Why do we want to learn how to trade? Why do we want to trade the markets? You always have to ask yourself that question. Why do you want to trade? Why do you want to learn how to trade? The other question is, when should you trade? When should we trade? Can you just trade any time of the day, any day of the week? Or are there particular times you should trade or particular times you should not trade? So when should you trade? And how do you trade? How do we trade? How do you enter the market? How do you exit the market? And what are the tools required for trading? So those are the questions we're going to go through now, and obviously how much do you need to trade? So you have to ask yourself the questions. Why do you want to learn how to trade? When should you be trading? How should you be trading? What are the tools you require for trading? And how much do you need to get started with trading? So let's start with, why do we trade? People trade for many reasons. There's so many reasons why people trade. Trading can offer you an opportunity to make a quick buck, which symbolizes freedom to many people. So it's about making money. For some people, trading means one can become their own boss and determine his or her destiny, provided you're trading right. So trading can offer you that opportunity to be your own boss. And some people trade for the excitement and the adrenaline rush because it involves pitting your wits against the very best, which is challenging and exciting for the risk taker. But trading is definitely not for the risk adverse, because like we said earlier, trading is high risk. Trading is a high risk form of approaching the financial market, so it's definitely not for the risk adverse. It is a high risk way of approaching the financial markets, so always remember that. But remember that trading well will make you money. That's the key. So your key reason for why you want to learn how to trade is you want to learn how to trade to be a good trader. So your sole focus as to why you want to trade should be on becoming a good trader. And a good trader is defined as someone who applies the 3 M's to every single trade they place. And that should be your goal, not making money. So your focus shouldn't be on making money. Your focus should be on trading well and making sure you're being consistent and applying the 3 M's to every single trade. Because if you trade well that way, by applying the 3 M's, you will make money by default. But if your aim is just to make money rather than trade well, you may lose an obscene amount of money. So the reason why you should be learning how to trade is to become a good trader, and a good trader is defined as someone who consistently applies the 3 M's to every single trade they place. Now, traders who trade for the excitement and the thrill are liable to take trades with bad odds and accept unnecessary risks. So again, you should remember that trading is not a game. It's not for fun and games. You need to be taken seriously, and you need to apply the 3 M's to your trading. You also have to remember that the financial markets are unforgiving, and emotional trading results in heavy losses. The financial markets don't care who you are. They don't care what your circumstances are. They don't care what emotional state you're in. They are very unforgiving. And, if you approach the markets with emotion and you're doing emotional trading, you will end up with heavy losses. So you need to check your emotion and not take your emotions into the markets. So when should you trade? Can you just trade any time of the day or any day of the week? Or when should you not be trading? When should you trade? Now, before you trade, you must examine the market conditions adequately in order to assess when to trade. So you need to find out, are the market conditions conducive for trading now, or are they not conducive for trading? Now, if you just have an irresistible urge to execute trades, you are no different from gambling. So in which case you may need to consider joining your local chapter of Gamblers Anonymous if you can't stay away from trading. So you shouldn't, as a trader, it doesn't mean you have to force a trade and be trading all the time. If you should not be having this irresistible urge of executing trades regardless of what the market conditions are like. So you need to be able to assess the market conditions and only trade when the market conditions are right. Now, successful trading just implies trading when the odds are in your favor. So as a trader, all you're just trying to do is stack the odds in your favor. So what we're trying to say is now, if you find that the market is trending up, that's an indication to buy. And if all the parameters and the economic data suggest the market is going to go up and the trend looks like it's going up, then you buy because you're now putting all the odds in your favor. Now, you're not saying that, look, the market is now trending up, all the indicators show the market is going up, and then you want to sell against that market, and obviously you're not putting the odds in your favor. So successful trading implies trading when the odds are in your favor. Continuing on when we should trade, again, although you may have a brilliant trading system, but if you feel frightened or upset, your account is likely to suffer. So again, you should not be trading when you're not emotionally stable. If you're feeling angry, if you're feeling upset, if you're in a bad mood, or even sometimes if you're excited and you're very happy, you should not be trading. You need to be calm, you need to be focused, you need to have a rational mind before you start trading. So you should not be trading when you're not in a calm emotional state. So your success or failure as a trader is dependent on your ability to control your emotions. Very, very important. Now, in addition, you should avoid trading when there's important news due to be broadcast. So you need to always check the economic calendar to see if there are any reports of high importance due out on that day. And obviously, if you see that there are reports due out, then you want to avoid trading because trading prior to reports of high importance can lead to you losing money prior to that. So you want to avoid trading prior to reports of high importance. And the only way you can know there are reports of high importance due out is by you checking the economic calendar. So what are the rules of trading? There are rules to trading. So according to Warren Buffett, who is the world's richest investor for many years, there are two rules of trading and investing, being rule 1, don't lose money, and rule 2, don't forget rule 1. So money management and risk management is absolutely crucial to your success as a trader. So you must remember that trading in the right way with the 3 M's in mind will make you money. However, like I said, if your aim is just to make money rather than trading in the right way, this may result in the loss of an obscene amount of money. So you should always focus on being a good trader by applying the 3 M's to every single trade you place. So how do you trade? It's very, very important that no trades must be placed without having an exit strategy. As a trader, you have to have a plan. You need to know when you're going to enter, where you're going to enter the market, and most importantly, you need to have decided before you place that trade when you will exit the market in terms of cutting your losses or taking your profit. So you must have an exit strategy before you place your trade. So no trades must be placed without having an exit strategy. Now, as a trader, we all go through losing streaks, so it's imperative that positions are kept small during losing streaks. And that's part of money management. So no one trade should put your whole account equity at risk. You should never, under any circumstances, blow out your account with one trade. If you ever blow out your whole account with one trade, that's just poor money management and bad money management. So no one trade should put your whole account equity at risk. So you need to treat trading like a business. Nobody starts a serious business without the business plan. So you have to have a trading plan. And like I said, the trading plan is a whole topic in itself, which we'll be covering in the next couple of weeks, leading up to the 2 weeks live trading session. So you always have to have a trading plan before you start trading. So here are some special points of interest. You always have to remember that directors may lie. News forecasters may lie. Don't believe all you hear on the news. Brokers may lie. Accountants may cook the books. But the charts never lie. And it is no secret what the charts tell you. So technical analysis is very important in trading. And, if you are unable to read the charts, it could seriously handicap your trading. So you need to remember these special points of interest. That is why it's important to have your own trading plan, your own way of approaching the market, and your own strategy, because you can't rely on what the directors are saying, what news forecasters and the TV are saying, what brokers are saying, or accountants are saying. So what are the tools for trading? What are the tools you need to trade? So once you've determined you want to become a trader, there are a few things you need to get started with. One, you need a personal computer with good memory. And this could be a desktop or a laptop. But the key is that it has to have good memory, at least 2 gigabytes, and at least a dual-core processor. So you need to have a very good laptop or desktop. Obviously, you need internet access, ideally broadband, so you can access the markets through the platform. And pen and paper for you to make notes on what you observe in the markets and keep a record of what you're doing. And that's really all you need. And obviously, you need money to trade with. And I usually advise people to start with $500 because $500 is a good way to start. It gives you enough in your capital so you can be trading for a long while without having to keep funding your account. Okay. So those are the tools you need. So you can see you don't need a lot in the way of tools to start trading. You also need to keep on educating yourselves as you do in other professions. So when you start trading, you don't become an expert overnight. So you need to keep educating yourself. You need to keep reading books. You need to go for seminars. You need to go for workshops. You need to watch educational programs on the markets. So you need to constantly update yourself and educate yourself. So trading is like any other profession, which requires discipline and diligence if you want to be very successful. So we all need to do research before putting in trades. So before you put in your trade, you need to assess the markets, assess market conditions, assess the charts before you place your trade. And like I said, you need to attend trading seminars and workshops so that you can get in-depth knowledge and in-depth teaching on the markets. Allocated time, you need to allocate time for your trading. It's very important. This is very, very important. So you should consider trading as a serious business and treat it like one. So you need to allocate yourself time that you're going to trade so that at that time you're focused without any distractions, which is very important. So like in any other business or job, you want to be free from distractions such as friends, telephones, TV, anything can distract you, because as we all know, when most people are at their day jobs or in their workplace, you don't have friends around chatting to you or you're on the phone or watching TV. So just like you do at your day jobs, you should have that same professional attitude to trading, whereby once you know, okay, I'm trading now, you need to block everything out, not be on the phone watching TV and being distracted, because there are a lot of decisions to be made while trading, and you need to be fully focused on your trading, otherwise bad decisions will be made. So that's why you need to allocate time for your trading and avoid distractions. So like I said earlier, having a trading plan is absolutely crucial to your success as a trader. You need to know how you're going to approach the markets. So you must develop a personalized trading plan, because without a trading plan, you're setting yourself up for failure. And like I said, this is a whole topic in itself, which we'll be covering in a couple of weeks and going through how you can devise a trading plan to trade with. So it's not only important to have a trading plan, but most importantly, you have to be disciplined, which is where the mind comes in, and stick to your trading plan. And that's usually the big problem with most traders, is that they do have a good plan, but the problem is that they are not disciplined and they do not stick to that trading plan. So there's no point having a trading plan if you're not going to stick to it. Obviously, to trade, you need to have a trading account. If you want to start trading, you need to open a trading account so you can then access the markets. It's now very easy to open an online trading account. We at dkbMARKETS, we do have a trading platform which we provide. dkbMARKETS partners with industry professional traders and platform providers with offices in London, Europe, and Australia. But we also have a focus in Africa. So for further details, you can go to www.dkbmarkets.com for details about dkbMARKETS and how to open an account, and then download the trading platform to start trading with. As a trader, you need to also start to read and understand the terminologies you hear in the financial markets. So you need to understand what they are. You know, things like uptrend, you need to know what an uptrend is. An uptrend is when the market is making higher highs and higher lows. You need to know what a downtrend is. A downtrend is when the market is making lower lows and lower highs. You need to know what bulls are. A bull is when the market is going up or the market is ascending or trending up. That's why you say the market is bullish. You need to know what bears are. Bears is when the market is selling or the market is falling. You say the market is bearish. You need to know what a market support is. You need to know what a market resistance is. You need to know what are indices, stock indices. You need to know what is called position trading or swing trading. So these are just some terminologies. There's so many of them. So if you want to take trading seriously, when you hear these terminologies, you need to know what they mean. You need to know how to define them. Otherwise, you just get yourself confused in the financial markets. There are different resources you can use now to get information on the website. You can go to marketwatch.com, thestreet.com, Money Show, stockcharts.com, babypips.com. All these websites give you free educational material that you can read up on the markets and educate yourself on the markets. So that's our contact details. So like I said, if you want to take trading seriously, you need to do some studying yourself. You need to approach the market seriously. You need to take it seriously. You need to do some private study. You need to read. And also, I always warn people that, trading is a practical thing. Trading is not theoretical. The only way you can become a good trader is by trading. So once you've decided you want to become a trader and start trading, as you're reading and you're getting knowledge, you need to also be trading and looking at the markets and placing trades, because it's a practical thing. And you can only become a good trader by actually trading the markets. Okay. Any questions? If you have any questions, do click the hand button or send your questions through to the question box.